For nearly a century, I have watched this world turn, watched empires rise and fall, watched technologies change, yet how constant human nature remains. And so, standing on the threshold of eternity, I recently told a 25-year-old investor something that made him weep. These were not tears of grief. They were tears of a sudden, blinding epiphany. This kid was an Uber driver. He worked night shifts, exhausting himself to the limit to finish college. And yet, he managed to save $5,000. Imagine the price of that money. Every bill in that stack was soaked in sweat, sleepless nights, fatigue, and the sacrifice of all the joys of youth. He asked me with a tremor in his voice, "Is there any point in even trying to invest such a tiny sum?" he thought. "Won't it be a drop in the ocean, a waste of time?" I looked him straight in the eye, with the eyes of a man who has seen the Great Depression, world wars, and every financial crisis of the modern era, and said, "Son, those $5,000 of yours are worth more than my first billion. Right now, you have access to opportunities that I would pay $100 million to access without a second thought. But I can't. I am too big for them." He initially thought I was just trying to be a polite old man comforting a young worker. He was wrong. I wasn't being kind. I was being brutally, mathematically honest. I was revealing to him the very truth that the investment industry desperately tries to hide from ordinary people. The fact is that having a small amount of money to invest is, perhaps, the single greatest advantage you will ever have in your entire investment career. And the tragedy of most people is that they are going to waste this advantage trying to copy what billionaires are doing now, instead of doing what billionaires did when they were small. Let me explain this to you in a way you will never forget. The 2 a.m. phone call and the curse of success. To understand the nature of your advantage, I have to take you back to 1963. That night, at 2 a.m., the phone rang. A call that forever changed my understanding of investing small sums. It was Al Marshall, a businessman I had met at a golf tournament a year earlier. When the phone rings at that hour, you usually expect tragedy, death, illness, disaster. Al was calling from a hospital, but not because he was sick. He couldn't sleep from the adrenaline. He was calling because he had just finished the calculations on our joint investment. We had invested just $1,000 in oil royalties, the payments from oil extraction. His voice was trembling. He was literally shaking with excitement, and I could hear it through the receiver. He told me, "Charlie, I just double-checked the numbers. Our $1,000 investment will generate $40,000 in cash flow over the next 12 months. Think about that. $40,000 from $1,000. In 1963, that was a huge amount of money. Al said, "I've worked 60 hours a week my whole adult life trying to earn $40,000 a year. And we did it with $1,000 and a smart legal structure in 18 months. I told him to calm down and try to sleep, but I couldn't sleep myself. And it wasn't about the money. I lay in the dark, realizing something fundamental, something that turns the entire logic of Wall Street upside down. I realized that small sums of money, placed intelligently in spaces where large investors simply cannot squeeze in, are capable of generating returns that are mathematically impossible for large capital. The story of that $1,000 didn't end that year. That investment didn't stop at $40,000. 60 years have passed. I am still here, and I am still getting checks. Do you know how much I receive? $70,000 every single year from that same $1,000 investment. Not $70,000 total, but $70,000 a year. The total income over 6 decades has gone far beyond $1 million. And all this from a single bet of $1,000. But here is what keeps me awake at night now, at 99 years old. I can never, do you hear me? Never make such an investment again. Not because such opportunities no longer exist. They do. There are thousands of them. But because I manage billions of dollars, an opportunity that brings in $1 million over 60 years is a statistical error for me now. It is meaningless for my portfolio. I have been literally pushed out of the best investments I ever made by my own success. I have become too big to bend down for the gold coins lying on the ground. But that young man with the $5,000, he can. He can still find those tiny cracks in the asphalt of the market where the huge institutional machines cannot fit. He has the advantage that I lost 40 years ago. And if he wastes it buying the same stocks that my company buys, I swear I will haunt him from the grave. Leave a comment. Write your city and the exact amount you have for investment right now. Even if it's $500. Even if it's $200. Even if you are ashamed of how small that number is, promise me that you will absorb every word, because I am going to share 3 specific principles that I used to get 50% annual returns when I was in your shoes. The conspiracy of silence and the lies of the financial industry. There is a sort of conspiracy of silence in the financial services industry regarding small sums of money. And since I am 99 years old, I have no bosses, no business relationships to protect, and I am not trying to sell you any product. I'm going to break this silence right now. The essence of the conspiracy is simple. Financial advisors, banks, and investment firms want to make you believe that small sums cannot generate significant returns. They brainwash you into thinking you need to save at least $10,000, $50,000, or even $100,000 before you can start real investing. They tell you to keep your money in a savings account at a meager interest rate until you are worthy of their attention. Why do they do this? For 2 reasons. First, cynical arithmetic. They cannot earn enough commissions managing your $5,000 to justify their time. They need you to wait until you accumulate more so they can take a bigger bite of your pie. Second, and this they will never admit, they genuinely do not know how to profitably invest small sums. Their entire training, their entire infrastructure, all their analytical departments are built around institutional scale investing. They literally, physically, cannot access those markets and opportunities where small money brings the highest returns. The truth that made that young taxi driver cry is the exact opposite of what they tell you at the bank. Warren Buffett, the greatest investor of our generation, has publicly and repeatedly stated, if I were managing small sums today, say $1 million instead of hundreds of billions, I could easily guarantee 50% annual returns. Not 5%. Not 10%, not 15%, but 50%. Why? Because thousands of opportunities would open up to him that are currently completely useless to him due to his scale, but which would be fantastic for a person with $1 million or less. Opportunities do not disappear as the market grows. Opportunities disappear as your capital grows. Your small money is your entry ticket to a world from which billionaires are forever banished. Let's look at this from a pure mechanics perspective. When Berkshire Hathaway considers a potential investment today, we need opportunities that can productively deploy at least $3 billion. That is not a typo. $3 billion. We cannot even look at an opportunity if it won't move the needle for our portfolio worth hundreds of billions of dollars. This requirement automatically filters out 99.9% of all businesses and opportunities in the world. We are locked in a cage with the largest companies. These companies are tracked by hundreds of professional analysts. Their stocks are traded by millions of investors, and their price is generally very efficient and fair. Meanwhile, there are literally thousands of small businesses, local opportunities, and specialized situations that would be perfect for a person with $10,000, but are completely useless to me. Imagine a small manufacturing company in rural Pennsylvania. It makes specialized parts for farm equipment. The whole company is worth maybe $2 million. It brings in $300,000 in net profit a year. It has no debt. It is run by a 70-year-old founder who wants to go fishing, wants to retire, but has no succession plan. And this business is selling for less than 7 times its annual earnings, simply because no one knows it exists. This is a diamond for a person with $50,000. You could buy a share, help the owner, and receive 20% annual returns for decades. But for Berkshire Hathaway, this opportunity is garbage. Even if I bought the entire company for $2 million, it would change the value of our portfolio by less than a fraction of a percent. It would cost us more in lawyers' time to draft the deal than the deal is worth. And that is how any large fund thinks. This means that this opportunity lies there, undervalued, waiting for the small investor. This is not a metaphor. This is a mathematical fact. And now I will give you 3 principles on how to use this. Principle 1. Hunt where the elephants are not. The first principle of profitable investing with small sums lies in what I call hunting where the elephants are not. Let me illustrate this with an example from my own youth. In the late 1950s, when I was operating with relatively modest sums, maybe $50,000 or $100,000, I discovered that I could beat the professionals by doing something laughably simple. I went to the public library. This was the time before computers, before the internet, before Bloomberg terminals. I took the industrial directory, Moody's Industrial Manual, and I read it. Page by page, page by page. These were massive volumes listing all publicly traded companies in America with their financial reports. Most of these companies were tiny. Market capitalizations of $100,000, $200,000, or $500,000. No mutual funds bought them. They were too illiquid. No analysts researched them. No one would pay for a report on a company of that size. They were completely ignored by the world of big money. And in this huge pile of forgotten companies, I found real treasures. I found businesses trading for less than the amount of cash in their bank accounts. I found debt-free companies that were worth less on the stock exchange than their net current assets. That meant you could buy the entire business for a price lower than the value of their inventory, plus accounts receivable, minus all liabilities. These were not speculations. These were mathematical guarantees. Here is a concrete example. In the 1950s, I found a small company that made spare parts for streetcars. It seemed like a terrible business. American cities were massively ripping up streetcar rails and replacing them with buses. Demand for their products was trending toward zero. The stock was abandoned by everyone because who in their right mind would want to own a dying business? The shares traded at $2 apiece. There were about 50,000 shares in total. The whole company was worth $100,000 on the market. But I opened Moody's manual and looked at the balance sheet. They had $120,000 in cash and securities sitting in their accounts. Plus, they owned the factory building mortgage-free, which could easily be sold for another $50,000. The arithmetic was shocking. You could buy the entire company for $100,000 and immediately liquidate it, receiving a minimum of $170,000. That is a guaranteed 70% return, with virtually no risk. You were simply buying a dollar for 60 cents. Why didn't Goldman Sachs buy it? Why did Morgan Stanley pass by? The answer is simple, and it explains everything. The total profit potential was only $70,000. Goldman Sachs has thousands of employees, huge overhead costs. They cannot afford to spend even a day of an analyst's work for a deal with a profit ceiling of $70,000. They aren't stupid. They are just too big. But for me, investing my own $5,000 or $10,000, making a 70% profit in 18 months was something incredible. I made more than 20 such investments over a few years, and almost all of them worked out exactly as I expected. I systematically made 40 to 50% annually, simply picking up what the elephants couldn't notice under their feet. Let me give you one more example so you understand this isn't a fluke. I found a textile company that was in the process of liquidation. It was officially announced that assets were being sold off, and calculations clearly showed that shareholders would receive $8 per share. But the stock was trading on the exchange at $5. You buy for $5, knowing that in 6 months you will be paid $8. That's 60% annualized without risk, pure arbitrage. But the whole company was worth $2 million, so institutions couldn't participate. I invested $20,000 and earned $12,000 in half a year. And today, these opportunities haven't gone anywhere. They just changed form. Now they are micro-cap stocks trading on the pink sheets, OTC markets, without analyst coverage. They are small private businesses being sold by retiring baby boomers. They are local real estate in tertiary markets, ignored by large developers. They are online businesses selling for 3 to 5 times annual earnings. They are collectibles, where your expertise gives you an edge over laymen. The essence is the same. Large investors cannot participate in small deals. This creates pockets of permanent inefficiency. The market remains inefficient precisely because big money cannot come in and correct the price. And this is your territory. Right now in America, there are hundreds of public companies with a capitalization of less than $10 million. Many of them are profitable, have no debt, and trade with a P/E ratio, price to earnings, of 5 or 7. These are not shell companies. These are real businesses. But an analyst from Fidelity will never spend time on them. These companies sit and wait for you. Principle 2. Swing hard when you are sure. The second principle. This is where 90% of small investors completely destroy their natural advantage. It consists of making massive bets when you find something truly worthwhile. Here is the typical tragedy of the small investor. He spends months researching. He finally finds one truly brilliant opportunity. A business trading at half price, a real estate deal that can't fail. And what does he do? He puts 2% of his portfolio into it because some financial advisor once told him, "Never put all your eggs in one basket. Diversify." This is a guarantee of mediocrity. This is a guarantee that you will never get rich. If you have $10,000 and you put $200 into your best idea, you are not investing. You are just playing around. You have wasted months of work. Let me tell you about my maternal grandfather. His approach to position sizing shaped my thinking. He was a pioneer who settled in Iowa in the 1860s. He had nothing but a willingness to work and an ability to save. He was a farmer. He saved every dollar, but more importantly, he observed the land around him with the attentiveness of a surgeon. He knew which farms had the best soil composition. He knew where there was access to water from creeks and springs. He knew which plots were closer to town and would appreciate as it expanded. He knew which neighbors were good stewards and which were drunks and loafers. He knew the economics of farming better than anyone in the county. Every decade or so, a financial panic occurred. 1873, 1893, 1907. Land prices crashed. Desperate farmers sold plots for pennies to avoid foreclosure by banks. And that's when my grandfather stepped onto the stage. He didn't buy 10 different farms in 10 different states to diversify risks. He took all his accumulated cash and bought 1, maximum 2 farms. The very ones he had studied for years. The ones that bordered his land. The ones he could personally supervise every day. He bought the best lands for 20 cents on the dollar from desperate sellers. He concentrated all his capital in 1 or 2 opportunities that he understood thoroughly. And then he waited. Sometimes 5 years, sometimes 20 years. Prosperity returned, prices recovered, and he sold at a huge profit or collected income from the harvest. Then he went back to cash and waited for the next panic. In his entire life, over 80+ years, he made maybe a dozen major investment decisions. A dozen. And he became the richest man in his county, even though he started with nothing. The lesson isn't in farming. The lesson is in concentration, patience, and aggressive betting. When you have an edge, you don't need hundreds of investments. You need a few outstanding ones. Let's look at the math. Suppose you have $10,000. Over 5 years, you find 5 good ideas. Option A, diversification. You put $2,000 in each. 4 double, 1 goes to 0. Total result, $16,000. Return, 60% over 5 years, or 10% annually. Not bad, but it won't change your life. Option B, concentration. You take your best idea, the one you are most sure of, and put $5,000 in it, 50% of your capital. If it doubles, and it should, if you've done the work, you already have $15,000 just from that deal. Then you wait for the next magnificent idea and bet 40 to 50% again. If you do this consistently, compound interest on large bets creates wealth that is mathematically impossible to obtain with wide diversification across mediocre ideas. I hear your objection. But Charlie, what if I'm wrong? What if I bet 50% and lose it? This fear keeps people in poverty. The answer is simple. You concentrate capital only where you have done such deep work that the risk of catastrophe is negligible. I'm not talking about betting on cryptocurrency or biotechnology on the advice of a brother-in-law. I'm talking about situations where you know the business better than its owners. where you know the assets are worth $2 and you are paying $1. Even if you are wrong 1 time out of 5, the winnings from concentrated bets on winners will more than cover the losses. This is exactly how Warren Buffett made his fortune. Look at his bet on American Express in 1964 during the salad oil scandal. American Express stock crashed 40% due to fraud in a subsidiary. Wall Street panicked. Everyone was selling, thinking the company was bankrupt. Warren didn't panic. He went to restaurants. He stood by the registers and watched people pay. They were still using American Express cards. He went to travel agencies. People were still buying travelers' checks. The scandal hadn't touched the core business, the goose laying the golden eggs. Warren understood this before anyone else, and he didn't buy a little bit of stock. He put 40% of his partnership's entire capital into American Express. 40%. It was a bet based on conviction and facts, and it became the foundation of his fortune. If he had invested 2%, it would have been just another lucky trade, but concentration turned it into a life-changing moment. Principle 3. Don't be afraid of a truly concentrated portfolio. The third principle ties everything together. Traditional wisdom says you need 20 to 30 stocks for diversification. This is advice for those who manage billions and are afraid of losing their jobs. It is not advice for you if you want to build capital from scratch. If you have $10,000 and you buy 30 stocks, you have $330 in each. Even if one triples, you earn $660. It won't change your life. You have created what I sarcastically call diversification. Worsening through variety, you have spread yourself so thin that none of your actions matter. Let me tell you about John Arrillaga. This man understood the concept of concentration at a level inaccessible to 99% of professionals. He wasn't a media star. For his entire 40-year career, he did only one thing. When he was in his early 20s, he made a decision that many would call insane. He decided he would invest exclusively in real estate, located within a 1-mile radius of the Stanford University campus in Palo Alto. Only there. No San Francisco, no San Jose, no office towers in other states. For 40 years, he did 2 things. When the market fell and everyone screamed about a real estate crash, he bought properties within his 1-mile circle. When the market was euphoric, he sold. He never used dangerous leverage. He never went outside his circle. He became a billionaire. John's genius was that he knew his 1 mile better than any other human on earth. He knew every building, every owner, every rental rate, every crack in the asphalt. He knew about university expansion plans before they were published. He knew zoning better than the officials. When an opportunity appeared, he could evaluate it in an hour, not a month, because he had decades of accumulated knowledge. From a textbook perspective, he wasn't diversified. His entire capital was in one dot on the map. But in reality, he was far safer than someone who owns real estate in 30 cities and knows nothing about it. True safety comes not from scattering your ignorance across many assets. True safety comes from concentration in what you understand absolutely and deeply. Your action plan. 5 steps. So, here is a specific implementation strategy that combines all 3 principles. This is what I would have liked to hear myself when I was 25. You can start this today, even with $1,000. Step 1. Choose one narrow area to dominate. Pick a sphere where you can become a world-class expert. It must be so narrow that you can realistically become the smartest person in that room. Don't try to be an expert in the stock market or real estate. That is too broad. Work in medicine? Focus exclusively on small medical device manufacturers with revenue under $50 million. Live near a university? Study student housing within a 2-mile radius. Programmer? Look for SaaS companies that could be acquired. The niche doesn't matter. Depth matters. Step 2. A year of obsessive study. This is the step where almost everyone fails. Spend the next 12 months becoming an absolute expert in the chosen niche. Read every book, report, article. Talk to every person in the industry. Visit sites. Create a database of every deal, every price. It is boring, unglamorous work with no instant payoff. But this is where your wealth is created. You are building a mental database that will allow you to instantly recognize a wrong price when it appears. I read Moody's. Buffett read Moody's twice. You must do your version of this. Step 3. Aggressive patience. After a year of study, wait. Wait patiently until you find one opportunity that meets the strictest criteria. An opportunity where you have an informational advantage, where the price is obviously wrong, where you can explain why the market is wrong. It might take 3 months, half a year, or 2 years. Do not force events. The worst investments happen when you feel money burning a hole in your pocket. Keep the money in treasury bills and wait for the perfect shot. Quality beats quantity. Step 4. The decisive bet. When you find that perfect opportunity, bet 25% or even 50% of your capital. You will be scared. Friends will say you are crazy. Advisors will be horrified. Ignore them. If you did the work from steps 1 to 3, this isn't risk, it's rationality. The biggest fortunes were built by people who bet big on their best ideas. Step 5. Unwavering holding. Practice absolute patience while your investment works. My oil royalties have been paying me for 60 years. Grandfather's farms grew for decades. The modern disease is checking quotes every 5 minutes. This destroys wealth. If you bought quality at a low price, time is your friend. Just wait and let compound interest work its magic. Epilogue. Your superpower. I have spent 7 decades watching how people handle money. Those who created life-changing wealth from small sums always followed this pattern. Deep expertise in a narrow niche, infinite patience in waiting, a heavy bet at the moment of truth, and long years of holding. Those who stayed poor or average did the opposite. They scattered themselves, chased trends, made tiny bets on everything in sight, and panicked at the first sign of trouble. Your $5,000 today is truly more valuable than my first $1 billion because you have access to inefficient markets, to concentrated positions, to opportunities that created every fortune I know. Don't waste this advantage pretending to be an institutional investor. You are not an institutional investor. You are small. And being small is your superpower if you understand how to use it.